Are you ready to transform your investment approach? Discover how to create a resilient portfolio that withstands any economic cycle. Money is an asset that carries risk. Many people think that if they save their money, they will be protected because it is less volatile. But look, in this scenario where we're generating more money, real returns are falling. It's a trap because in relation to inflation, you could be taxed up to 70% per year. This adds up over time and is a rate that creeps up stealthily. Keep an eye on that. So, I did a study and decided to share it because I think it's quite important. Remember 2008? Back then, we started printing money and accumulating a mountain of debt. From that, I realized there are three major forces at play. And then COVID-19 came along. The first force is the long-term debt cycle and money creation, which refers to the accumulation of debt and its consequences for the markets. The second force involves conflict, polarization, and inequality. I have studied inequality and conflict over time and noted that this occurred between 1930 and 1945. We also saw the printing of money during this period. The third force is the rise of China, which is becoming a great power and challenging the United States. This brings various implications, especially for us investors, who need to think about the dynamics between markets. It's not just a trade war. These forces are interconnected with trade wars, technological struggles, and geopolitical tensions, such as in Taiwan and the South China Sea. And there is also a new capital war. This led me to look back in history to understand the rises and falls of empires with reserve currency. I needed to look far back, about 500 years, to study how the Dutch Empire and its reserve currency formed and fell, as well as the British Empire. And now, we are seeing the rise and beginning of the fall of the United States as a reserve currency. The situation is quite concerning. And it becomes even more serious when I look at these 500 years and see the repeating patterns. What I discovered is that there is a cycle, a big cycle. We began a new world order in 1945 when we defined how the world would be organized and established the dollar as the global reserve currency. After many battles, we established centralized power and had a period of peace and prosperity. But this prosperity ends up encouraging the accumulation of more debts, and the fear of hard times limits the opportunities to borrow, especially if you have a currency that is the global reserve, as everyone wants to store their savings in that currency. This deepens the country's debt and results in rising debt and bubbles. And bubbles, while fun and providing a false sense of well-being, eventually show their limitations. They become clear when the central bank can no longer create money and credit easily. This happens when interest rates get close to zero. You can't apply the same monetary policy strategies. Traditional monetary policy is based on interest rates. When that doesn't work, the next step is to print money and buy financial assets. But this type of purchasing increases inequality because those who have financial assets benefit more than those who do not. This intensifies the wealth gap, and if a new economic slowdown happens, it's a recipe for a lot of conflict. And what does the central bank do? If it raises taxes, it withdraws money from the economy, which isn't good. It creates problems. If it cuts spending, that's also a headache throughout history, and this has been happening for millennia. The central bank always ends up printing more money. Remember what happened when we received those checks in the mail. We needed them, but you can't take money from someone else. So where does this money come from? And what are the consequences? This happens for logical reasons and often rises when there's a new external power becoming a competitor, complicating the scenario. Most people don't realize this. I learned from my experiences that many things that happened in my life surprised me because they had never happened before, but they have occurred many times in history. If I looked to the past, I would see that the first time something like this happened was in 1971, when I was working on the New York Stock Exchange, and Richard Nixon announced that we would no longer provide gold and devalue the dollar. I was shocked to see that, even so, the stock market was up 4%, the largest increase in decades. I found out that Roosevelt did the same thing on March 5, 1933. What happened on these two occasions is similar to what occurred on April 9th, when the federal government and the Federal Reserve decided to create much more money and credit. Therefore, we need to understand these perspectives. What we are seeing now is the increase in government debt and the allocation of this money to those who really need it. This is what is happening, and central banks are monetizing it. We are entering a new era, which I call Monetary Policy 3. This new phase means that the free market will have less influence on capital flows. The government, as we move forward, will be more focused on how to direct that money to those in need. This will make decisions much more political than they were before, and the central bank will monetize these decisions. Monetary Policy 3 brings this type of cooperation. We are talking about a significant change. The government will have much more control over where the money goes, which will significantly impact the economy and the markets. We will need to keep an eye on how the government spends its money and where it will draw resources from, such as taxes, etc. This means the government will have a stronger role. It also means there will be more debt being monetized, which brings implications for the value of financial assets, currencies, and so on. When you reach the end of this arc, the dynamics of money become crucial. If money is scarce, as when it was linked to gold, or if it was gold itself, there is always a break in that link. When there is abundance, money printing increases. However, you can't simply raise living standards by just printing more money. What you achieve is distributing it. The checks that some people receive help maintain their living standards, but this diminishes the value of that money and bonds, as they are promises to receive a certain amount. This ends up transferring wealth to financial assets, consistently raising stock prices. As we saw in the lesson from 1971, this also leads to an increase in the price of gold. Therefore, looking at the current scenario, I believe that the importance of the Chinese RMB as a currency will grow. Although it still has a long way to go to become a reserve currency, it is important to note that we will see capital flows favoring China. If you compare the Chinese markets, interest rates, and capital markets, you will see that this year, around 45% of initial public offerings (IPOs) will take place in Chinese markets in Shanghai and Hong Kong. Increasingly, the internationalization of the RMB will become evident, and capital flows will trend in that direction. These movements have already occurred repeatedly throughout history. Looking at this from the investment perspective, I would like to highlight a few key points. First, it is crucial to understand that money is not a safe investment. It is a risky investment. The second big lesson is the importance of diversification. Smart diversification means spreading your investments globally among countries, markets, and currencies. By studying historical patterns and understanding cause and effect relationships, it is possible to develop principles to deal with them. This was done effectively during the financial crisis and other debt crises, and I would like to share that model. I identify 6 stages of the cycle that I would briefly mention. First, we have the initial phase of the cycle, where debt is used to create productivity and income sustainably. Asset prices rise and everything looks great. Next, we enter the bubble phase, where everyone extrapolates what happened in the past, believing that assets will continue to rise. At that point, borrowing and leverage begin to be used. When you reach that phase, you begin to realize, when doing the math, that you may not be able to sustain that level of debt growth. Then we reach the third phase of the cycle, which is the peak, Normally, at this stage, central banks start to tighten monetary policy. Next, we enter the downturn phase, and as interest rates hit 0%, we enter a depressive part of the cycle, as traditional monetary policy often does not work when rates are at that level. At this moment, quantitative easing is needed to start a new expansion, restarting the cycle. I believe the current period is very similar to what we experienced in the 1930s. If you allow me, I will explain this better. In this century, we have faced debt crises only twice when interest rates reach zero. On both occasions, the central bank needed to print money and implement a differentiated type of monetary policy known as quantitative easing by buying financial assets. This process raises the value of those assets and generates a recovery, but also contributes to keeping interest rates near zero. Currently, over $15 trillion in financial assets purchased have driven both asset prices up and reduced interest rates. This has caused a significant rise in financial asset prices and has also led to a growth of populism, as this process generates disparities between the rich and the poor. Those who own more financial assets see their prices rise, resulting in increasing inequality. The net wealth of the top 0.1% of the population now equals the sum of the wealth of the bottom 90%, which harkens back to the situation at the end of the 1930s when we observed stimuli and other similar conditions. We are now in the final phase of the quantitative easing cycle, where most of the energy has already been used. Asset prices continue to rise, interest rates remain low, and we are entering a sort of stagnation in monetary policy, very similar to what started in 1937. Furthermore, the political landscape is marked by an increase in conflict between the rich and the poor, which fuels the growing populism around the world. This rise in populism results in the selection of more decisive leaders, who tend to be more nationalistic. Thus, we find ourselves in this position. You raised an interesting point about the cause and effect relationships, especially in contexts of wealth inequality and economic slowdown. With an ever-widening chasm between the rich and the poor, budget division indeed becomes a delicate issue, where the interests of both sides can come into conflict. This situation is amplified by international tensions, as economic slowdown in one country can create chain reactions affecting other nations and creating an unstable global environment. Your analogy of the 9-inning game is quite pertinent. We are indeed in the final phase of an economic cycle where monetary policy is becoming more restrictive, and this limits stimulus options. When interest rates begin to rise, especially if that happens more quickly than expected, there is a risk of triggering significant adjustments in asset prices, which are already calibrated to lower interest rates. This pressure can eventually lead to an economic slowdown, which is the root of recessions. While it's hard to predict exactly when this will happen, your estimate of a 2-year time frame seems reasonable considering the current context. The parallel you draw between the rise of China and the dynamics of powers at the end of the 1930s is a valid point. The emerging rivalry between established and rising powers, as happened with the US and Britain in relation to Germany and Japan, is a legitimate concern. Economic competition can quickly transform into sharper rivalries, and China, as an emerging power, is definitely at the center of these tensions. Although historical parallels are notable, it is important to remember that we are capable of shaping the future in ways we may not have succeeded before. We need to remain vigilant about the potential for a slowdown and the risks it could entail for the effectiveness of monetary policy, which may not have the same impact it had in previous cycles. Your advice for investors is wise. Maintaining a margin of maneuver and addressing the growing wealth inequality and its geopolitical consequences is essential. In times of uncertainty, a diversified and careful strategy can be the key to navigating an increasingly complex economic environment. Your analysis of the privileged position of having a reserve currency and the importance of effectively managing debt is very pertinent. Indeed, countries that can denominate their debt in their own currency have a significant advantage in financial management, as they can implement fiscal and monetary policies that adjust to their internal economic needs. However, as you noted, this does not diminish the challenges that rise with pension and healthcare obligations that may surface in the future. Regarding investors, you raised crucial points about asset allocation and tactical bets. The idea that the average investor should avoid attempting to time the market is a valuable lesson backed by history. Investing with a long-term approach and focusing on a strategic asset allocation tends to yield better results than trying to buy and sell based on market predictions. The example of Peter Lynch's Magellan Fund is a great case to contextualize this. Even in a heated market environment, investors who entered at the wrong time or exited during times of despair ended up losing money. This fluctuation in investor behavior, driven by emotions and reactions to news, highlights the intrinsic difficulty of trying to guess the direction of the market. Thus, the pursuit of balance in a portfolio that not only preserves returns but also significantly minimizes risk is crucial. Structuring a diversified portfolio that adjusts to the investor's risk tolerance and long-term goals is a wise approach. This allows investors to face market uncertainties with less anxiety and more assurance. In summary, focusing on solid investment strategies and avoiding impulsive moves can be the key to navigating challenging times and developing a sustainable long-term portfolio. You brought forth a very solid investment strategy by discussing the construction of an all-weather portfolio. The concept of a balanced portfolio that is not overly exposed to a single economic environment is crucial, especially in times of volatility. The approach to buy when there's blood in the streets and sell when everyone is euphoric is a classic investment principle that has its merit. This contrarian view requires courage and strong discipline, as it's challenging to act when the majority is optimistic or pessimistic. The way you describe the necessity to distance oneself from the crowd, especially when indicators like unemployment rates and asset prices are at extremes, is essential to avoid the herd behavior trap. Additionally, your focus on various metrics, such as the use of debt to finance purchases, the sentiment of euphoria, and comparisons between stock and bond yields, is very relevant. These analyses not only provide a comprehensive view of the market environment, but also help identify potential weaknesses or moments of overvaluation. The idea of observing the discounted future image is especially important. This proposed approach evaluating present value against what is embedded in growth expectations is a fundamental practice for investors seeking to avoid excessive valuation traps. Major market movements often occur when expectations are quickly adjusted. So being proactive in identifying these signals can help protect the portfolio. In summary, what you describe is an approach based on fundamentals, rigorous analysis, and emotional discipline, which is vital for any investor wishing to shield themselves from the uncertainty of the future, thereby reducing risk while offering potential for sustainable long-term growth. This strategy is not just sensible, but it also fosters a mindset that prioritizes rationality over emotion, something that is key in the investment world. If you enjoyed this content, don't forget to subscribe to the channel and turn on notifications for more amazing investment tips. Share your thoughts in the comments, and let's build a solid financial future together.